Good morning and welcome to today's session. Again, it is going to be very extremely interesting and at the same time very debatable. Valuation date, valuation report date, and event falling within these 2 points of references. Today, in this distinguished panel, we have CA Anil Bhandari, Chairman of the ICAI Valuation Standard Board, CA MP Vijay Kumar, Vice Chairman, who is going to moderate the session, and CA Tarun Mahajan, who is a registered valuer and has been helping ICAI RVO in many educational activities. And my colleague CA Sarika Singhal, who is the secretary on the board. Now, I'll set up a brief context why this topic is important. It is because the value is likely to vary with the change scope and time. Since once the context or time changes, the valuation is likely to change, as the major premise on which the report was built is maybe going to differ. Now, the process of valuation being sum total of many parts, this not only relies on the secondary source of information, but the targeted primary data, which is yielded through inspections and investigations. And these factors, are they prone to changes? And coupled with that, the process of valuation not being an exact science, but combination of art, since it also relies on professional skepticism and judgment. The ultimate factor being the propositions on which the valuation was drawn, the current business evaluation vis-a-vis industry, past financials, reasons and circumstances on which the business valuation was built. The premises, if they change, the valuation is likely to change. So I think we'll have an interesting this knowledge dissemination. With these words, may I now request CA Anil Bhandari ji.
So thank you, Rakesh ji. Thank you very much. And I think you have very aptly summarized this. So thank you for that as well. I think it's a good starting point for Tarun. But I think I'm really excited. The only thing that I've learned in a couple of last Sundays is that valuation is a moving target. And now here comes the dates, and then comes the scope, and then comes the event. So it's really getting exciting by the day that we discuss valuation. And I'm really glad that, we're doing this every Sunday. So without much time on this, I would, of course, invite my friend and colleague in the Central Council, MPV, of course, to take this forward. And thank you, Sarika, once again, for getting us all together on this Sunday morning. You seem to be like a movie director now, getting this right every day. So thank you once again, and welcome, Tarun. I'm sure this is going to be very, very interesting. So I understand that, you're also into, I wouldn't say teaching, but you do enable people to learn finance. So you have MPV, who's one of the, I don't know what to, I don't have words for him. People in South, he's like Rajnikant, right? So you're going to have a tough time today. And welcome everybody and all our viewers. And MPV, on to you. Thank you.
Thanks, Anil, and good day to all. Tarun, hearty welcome, and thanks for accepting our invite to be here today. As far as today's topic is concerned, dating with valuation date, valuation report date.
Yeah, that should have been our topic light. Yeah.
I actually drafted that, Anil, but then I thought that the institute document I didn't want it.
You've not realized institute has changed, MPV. Don't worry about all these.
So, okay, just to reiterate, dating with Tarun Mahajan on understanding valuation date, valuation report date, and events between these two dates. So, Tarun, some quick opening remarks before we can get into specific questions.
Sure. So, it's an honor to be panelist with MPV sir and Anil Bhandari sir. Thanks, Sarika ma'am and Rakesh ji, for giving me this opportunity to interact with thousands of my colleagues. Before coming on to the point, I believe that some participants here are already valuation experts. So I asked them not only to ask the question, but also to share their experience regarding this particular topic. So just like we compile question, we can compile your experiences also. At the other hand of the spectrum, there must be participants who are new to valuation. So I'll take care that throughout the session I discuss some of the relevant fundamentals also and some of the relevant laws also. Now coming on to the point, in financial economics, there is a term which is called efficient market hypothesis. And it says that value of any asset at any point of time reflects all available information. Interestingly, whether the information is available publicly or it is held privately, it is reflected in the price of the asset. And as soon as a new information arrives, price adjusted automatically in the market. So if if the valuation is so date specific and so time specific, we see, you might have observed many a times that value of some of the assets remain constant for a very long period of time, and the reason being no new information arrived in the market, and sometimes value of some of the assets changes very quickly, maybe within a day, minutes, or sometime within seconds also. So what I say is valuation is not only date specific, but also it is time specific. Now the question is, why do we need this thing that there is one valuation date and one report date, and we need to take care of the events which happens between these two dates? So to put it into the context, let's take one example. Like a company wants to make preferential allotment of its equity shares. So what is the chronology? What is the whole story? First of all, it comes to the mind of the management of the company that they need fund. Thereafter, they identify investor. They have informal talk with the investor. Then they agree that, okay, in principle that, okay, we will invest here. Then they identify a valuer, make appointment of valuer. Thereafter, valuer makes valuation. Thereafter, he signs his report. Then the report is submitted to board. Then board meeting decides about AGM, EGM, whatever it is. Then special resolution is passed. Then the board gives offer. Then people give application. Then the board meeting makes allotment of shares and give either the physical security or securities in demat form. This whole process will take, say, 1.5 months or 2 months time. And now the question is, at what point of time there came into existence a binding agreement between the company and the investor? Was it the date of receipt of application? Was it the date of receipt of money? Was it the date of allotment in the board meeting? Or was it a date for which the two parties agreed mutually? Or is it a date which is specified by some law or by the accounting standards? So if valuation is done on that particular specific date where the ownership is changing hands, if that date is chosen as the valuation date, then I believe there will not be any need of adjustment of post valuation events. But if the date chosen is either lagging behind, then we need to make the roll forward adjustment, or if the date chosen is leading, then probably we'll have to make the roll back adjustment. So I would like to conclude this opening remark by saying that rather than asking what events should be adjusted, a better question would have been that what should be the right valuation date. I'm sorry, I would just like to add one more thing, that for this purpose, I'll divide all valuations which can be done by a valuer into two parts. One is a pre-transaction valuation and one is a post-transaction valuation. So this is my classification. It is nowhere given in any standard or law. Pre-transaction valuation means first I make the valuation and then the company or other party act based on that valuation. Post-transaction valuation means transaction has already happened and now I am making valuation. So when I'm making valuation under the Companies Act or under FEMA, or under IBC or under SEBI guideline, I believe it is mostly a pre-transaction valuation. But when I'm doing valuation under income tax or for the purpose of some litigation, legal dispute, or I'm doing valuation for Ind AS purpose, I believe mostly it is a post-transaction valuation. So a broad classification will be, in case of pre-transaction valuation, I must adjust events up to the signing date, not up to the valuation date. And in post-transaction valuation, I must adjust event only up to the valuation date and not thereafter.
That's very helpful, very neatly illustrated. Can you, in the context of ICAI valuation standards, what are the provisions there relating to valuation date and how the subsequent events after the valuation date need to be taken into account? What is the technical guidance available?
Right, sir. So, like among all valuation standards available across the world, I believe the best guidance which is available for this particular thing is available in ICAI valuation standards. Not because I am a member of Institute of Chartered Accountants of India, but actually I have compared all and I found the best guidance is available under ICAI valuation standard. So here I would like to quote two standards. One is ICAI valuation standard 202, which is about reporting. And it says the valuer must report 3 dates. One is the date of appointment. Many other standards don't provide that you need to say the date of appointment also, but we are exhaustive enough. You need to provide date of appointment, date of valuation, and the date of valuation report. And then ICAI valuation standard 201, scope of the work. There are 4 paragraphs, 36, 37, 38, and 39. So I'll read out 2 paragraphs out of that. 36 says that valuation date is the specific date at which valuer estimates the value of the asset. And 37 says that, now 37 is very interesting. Just like Ind AS 10, 37 is also talking about 2 types of events. An event that occurs subsequent to valuation date, that is in 38, could affect the value. Such an occurrence is referred to as the subsequent event, and subsequent events are of 2 types. One, those are indicative of conditions that were not known, though those conditions existed, but were not known at the valuation date, and those events which occurred subsequent to the valuation date. The interesting thing is, if I am making adjustment, say for the purpose of companies at valuation, I'll make adjustment of both events. Say I'm doing valuation for the purpose of preferential allotment of shares. I'll make adjustment of both events. Now, paragraph 39 is again very exhaustive. It says that generally a valuer will consider only events which occurred up to the date of valuation. But then it leaves to the professional judgment of the valuer that he needs to decide that should I consider the event which occurred after the valuation date or not. And if he is using those events for the purpose of valuation, he needs to specifically disclose it in his valuation report. And very interesting thing, it says that 3 types of events can occur. Paragraph 39. So very meticulously designed paragraph. Number 1, the event may be related to the asset itself. So I'm making valuation of the company and there is a good news or bad news about the company in between. Number 2, it is talking about change in the comparables. So suppose I'm using the enterprise value to EBITDA ratio or price to earning ratio, and between these 2 dates, government makes some announcement about policy change, and suppose the price earning ratio of steel industry as a whole comes down between these 2 dates. It is talking about adjusting those events also. And number 3, it is talking about parameters used in valuation. So one of the parameters is say risk-free rate of return for DCF technique. if between these two dates there is a substantial change in risk-free rate of return. Suppose the budget arrives and people start thinking this is very inflationary budget, and in years to come inflation rate in India will be very high. In response to that, the risk-free rate of return in the market rises, say by 50 basis points. Now that's a considerable change. So those parameters also, if they change, it is the professional judgment of the valuer that should I consider it or not. And if he considers, then he must actually disclose it.
That's pretty helpful, Tarun. Just to extend this, you are aware in the context of Companies Act, for mergers and all, we have the concept of appointed date. And there is an MCA circular regarding the determination of appointed date, which can be antedated, post-dated, 12 months, etc. So in the context of that circular, and generally in the context of company M&As, how do we deal with the concept of valuation date and the events after that? Because the NCLT approval is a fairly long drawn process.
Right. So yeah, here there is one interesting thing that preface to ICAI valuation standard specifically says that if the law asks something else, then valuer need to follow it. Now, Ind AS is also, business amalgamation accounting is specified as by section 133, so it is also part of law. So if the MCA circular is saying something else, then definitely we'll need to follow it. Here I would just like to give a quick background that around 10 sections are there in the Companies Act which says that valuation is compulsory, must be done by registered valuer. Company cannot deal at a price other than what is certified by the valuer. There are 3 sections which says, okay, either you deal at the price certified by valuer or at a price above that. And rest of the section says that you should deal only at that price, neither above it nor below it. So what does it mean? First valuation will happen and then transaction will happen. So as per my classification, it's a post-transaction valuation, I'll say. And as MPV sir has rightly pointed out that the merger process is really a very long process. Like if I take an example of Vodafone Idea merger, the valuation report was signed on 19th of March 2017 and merger concluded on 31st of August 2018. Roughly 1.5 years time period. Even the shareholders meeting happened in October 2017. That is 6 months after the valuation date. So you are asking shareholders to approve a price which was determined 6 months back. Now, similarly, in the case of merger of Hindustan Unilever Limited and GlaxoSmithKline, the merger valuation, the valuation report was signed on 3rd of December 2018 and merger concluded on 1st of April 2020. So time gap was again roughly 1.5 years. So the day valuation was made, HUL was supposed to pay 32,000 crore rupees as a consideration, obviously in terms of shares, not in cash. But after 1.5 years, when merger was concluded and accounting was done under Ind AS 103, it was not at 32,000 crore rupees, it was at 40,000 crore rupees. So meanwhile, the valuation increased by, the consideration value increased by 8,000 crore rupees. In that particular deal, the goodwill recognized in accounts was 17,000 crore rupees. So this is partly due to the time gap when the valuation happened and when effectively the merger actually concluded.
Yeah, Tarun, I just wanted to take you back. I think you gave a wonderful example on Voda Idea, and I believe that in that period, I think the value actually substantially deteriorated, if I'm not mistaken. My apologies for that ignorance, but what happened to the valuation finally? What number did it change? The transaction concludes or?
Right. Oh, that was for HUL and Glaxo. So that initially the valuation was 32,000 crore rupees to calculate the exchange ratio.
No, I'm taking you back to Voda Idea.
Voda Idea. Yeah, so valuation, the merger transaction actually happened at the price whatever was decided, but even I cannot recall that at the time of amalgamation.
So what happens in this? So okay, of course the price was higher than probably what it would have been valued after 1.5 years. So it's still fundamentally right because somebody is paying more price for that, correct? But Idea was a listed entity. Vodafone was not a listed entity,
right?
Which means the Idea shareholders ended up paying more for Vodafone.
I'm really sorry, I cannot recall the exact numbers from that.
Okay, I'm saying hypothetically, if the value is say 100, and because the time has passed, and we've agreed on that transaction, because the time has passed, somebody would be expected to do a valuation closer to the transaction date or not expected to do closer to the transaction date?
Closer to the transaction date.
Somebody would be expected to again value it, correct? Like how they did it in Hindustan Lever or whatever. And if the valuation is substantially, maybe say substantially lower than 100 rupees, it's come down to 50 for whatever reason, 1.5 years, right? Then what happens fundamentally? I mean,
so there are two things. One is valuation for transaction, and then the second one was valuation for accounting. So valuation for transaction suggested that 32,000 crore rupees is the consideration, full stop. And the transaction happened at that price, means number of the swap ratio, exchange ratio was decided accordingly. But this is one thing that transaction happened, that after 1.5 years, the accountant came into the role and they said, okay, now we need to account for all the assets taken over, liability taken over at the fair value, and the difference amount to be accounted for as goodwill. Now they will not accept the valuation which was done for the purpose of transaction 1.5 years back. They will need a fresh valuation on the date of acquisition. So actually two valuations will happen. One for transaction and the other one is for the purpose of accounting later.
Okay, so maybe not a right question for this forum, but MPV, I think we had done this discussion from a tax perspective, from a company's perspective, right? And I'm only saying that if the value is substantially eroded, then there is a transaction that we have agreed at 100. And then because of the difference in the dates of when the transaction is getting sorted out, so and the value comes down. Are you getting impacted in any of the laws here? Tax, would you get hit by? Companies Act, of course, you'll not get hit by because you'll do your accounting based on the new numbers. Are we getting into a tricky situation because of this transaction?
Not really, Anil. In fact, you are agreeing on a particular date on which values have been determined. Subsequent to that, values could have gone up, come down. Either of it could have happened. So there are examples, umpteen where value have come down, where they have gone up as well. So we don't go and correct that valuation. So the instances where you go and address is only for the events between the valuation date and the valuation report date. In the example of ODA or whatever we are discussing, the valuation report date has already factored events up till the date and the transaction exchange ratio. So with that, both parties have decided that we will take the corresponding risk and rewards.
Go ahead with the transaction. Okay.
Exactly.
No, I was only coming from an income tax perspective that, for example, if I land up paying more and the value is, I land up paying less and the value is actually more, it will get into a tricky situation there, right? Because now the time has passed.
Exactly.
I would like to, sorry to interject.
Please.
Yeah, because under income tax, they have specified valuation date specifically. Like Rule 11U specifically says that this is the date of receipt of consideration, for example, in case of 5627B, issue of shares. The date of receipt of consideration is deemed to be the date of valuation. Now, whatever is your actual transaction, that hardly matters. Even if the shares are allotted later, that's fine. They assume the day you received consideration is the valuation date. Now make valuation accordingly.
Fantastic. So you have one more date, which is the date of receipt of the consideration. Lovely. Yes. I never knew this. Yes.
So
and the date seems to be more complicated than the standard numbers that one has to remember now. Cool.
Dates are always.
Then the next question: if the difference between the dates of the value and the date of the certificate, are you mandated to look at anything which happens after that, or you said it's a professional judgment for somebody to look at after that? And if it is significantly changed, then of course, professional judgment says that you should look at it, but currently it's not mandated. You can live with the value and you can issue it on a particular day. Okay.
Yes.
Fair enough. All right.
So in fact, on a lighter note, I'll say that if mergers are like marriages, the valuation date is like the date of engagement. And there is a long courtship period and many things can happen in this period.
True.
So the job of the valuer is, to keep the valuation date as close as possible to the report date, because already there is a lot of time gap. So at least at my end, it should be my duty to keep the valuation date as closer as possible to the report date. Like if I see in Vodidea report itself, so that report was pre-ICAI valuation standard era.
So I think I have again a question for you. Why should somebody take a lot of time between the date of valuation and the date of report? It should be in the normal course of business, right?
Because sometimes the management demands it like that. They give you an appointed date. Like usually, if I talk about the situation when Ind AS were not there, the appointed date used to be the valuation date as well as the date for the purpose of accounting, if I'm not wrong. So most of the time. So sometimes, the management itself gives you a date that, okay, we want, in your appointment letter, they'll say, we want a valuation date to be like this. Either you can educate them that, okay, let's not have such a big time gap. Or if they don't agree, no, we want valuation for this particular date, then we can separately consider the events which happen.
So MPV, is there a reason why one would want to do this fundamentally? And why would professionals look at a date which is kind of given on a particular, of course, there could be superstitions or stuff behind that, but I'm saying I've valued it in my normal course. I should issue the report in the next 5 days, 7 days, 10 days. Yeah. Why should I issue it after 1 month and get into a tricky professional zone of looking at what has happened, not happened, take a professional view of it, etc., etc.
That's a very good point, Neil. 2 reasons it happens. One is the valuation date to valuation report cannot be as short as 5 to 7 days. It depends on the size of business, complexity of the industry and all. My experience, it takes 4 to 6 weeks for a reasonably large entities, because you have to get the assumptions, validate the assumptions, exchange information back and forth. It's at least 4 to 6 weeks. It's less to do with the spreadsheet modeling thing. This 1 week kind of a thing typically happens for impairment valuations. So impairment valuations where I have, let's say, goodwill in my books, the standards require me to value it every year. So I have a certain set of assumptions I made last year. I would give it this year. So he just plugs it because he already knows my industry, etc., etc. So there it's relatively short. But if you take M&A, those kind of transactions, it does take that at least 4 weeks. Less than 4 weeks, I would be little pleasantly.
So what you're telling the viewers is that it is important for you, after having come to a value, to look at what has transpired in the last 4 weeks or whatever the rate is. And ideally, the valuation report should not be too long compared to the valuation date that you're trying to do, right?
Second reason, Anil, is, let's say today we are discussing about valuation relating to, I want to, let's say you are kind enough to allow me to become a shareholder in your company. So what I would typically do, I would take 31st March as a base. So I would tell you it's an audited financial statement. So I feel all necessary aspects have been considered, compared to an unaudited position or a broken period audited statement like 31st of May. So I would agree that both of us would sign saying that let's agree on 31st March as valuation date. From here, it takes 4 weeks. So effectively, there is 12 weeks of time which he has to keep in mind. So this is how the differences come.
All right.
Right.
And
thank you.
Tarun, just to continue, I think this discussion is incomplete without talking about IBC.
Right.
So, in the context of IBC, and Anil, what you mentioned is far more acute problem in IBC. There are many IBC cases where it takes a very long time because there are bidders, there are creditors, and all kinds of, sometimes the promoters themselves going on appeal. So all these issues are there. So what kind of practical situations you have come across with reference to gap between valuation date and the valuation report?
Right, sir. So though the IBC itself says that the maximum time period is 330 days within which the resolution must happen, but practically sometimes it takes longer than that. And in fact, 330 days itself is a very long period. So the whole, from valuation perspective, so the whole process starts like if somebody, financial creator or the operational creator or the company itself goes to the authorities, adjudicating authority, and if they admit the claim, the date of admission of claim becomes CIRP date. So we were doing one valuation in like November 2020, and the date of CIRP was November 2019. Date of CIRP was a year back. So CIRP case was admitted in November 2019, and somehow RP could not appoint the valuer. He did, then the pandemic was there, and thereafter he made appointment somewhere in August 2020 for the valuation. And that was a very complicated valuation. Many subsidiaries were there. A lot of real estate was also involved. So the process was also taking time, as MPV sir said, that you cannot do it suddenly. A lot of things are there. You need a lot of confirmation. So this is the huge time gap. Now, in one such other case, what happens that sometimes the valuation done by the SFA valuer is dependent on the valuation done by land and building valuer or the plant and machinery valuer. In one case, what happened that the land and building valuer said, now there are 3 dates, now not 2. One is the valuation date, one is the report date, and one is the inspection date. So these guys, land and building and plant and machinery, for them inspection become very important. For SFA valuers, mostly we value data, short-term loan securities. For us, inspection is not really that important. So he said, I will not give my valuation date as the CIRP date. I'll give my valuation date as the date of inspection. How can I certify something which I have not inspected at that point of time? See, many land and building, plant and machinery valuer agree. Looking at the situation that no substantial change must have occurred, so they agree. But sometimes they don't agree. In that case, even the RP admitted, okay, fine, you give your valuation date as the date of inspection. Now, as an SFA valuer, I am using that report because he did valuation of assets of subsidiary. And now I have to make valuation of subsidiary as a whole, not of land and building. So I'm relying on his valuation. Now that's a problem. He stated that his inspection date is valuation date. And now if I'm saying for rest of my asset, the valuation date is CIRP date. And here is the inspection date. So a special note need to be given about that I'm using his work and he has specified this date. Allow me to quote one more interesting example. So what happened that in a case, valuation was done 4 times in a CIRP case. 1, then 2nd, then 3rd, and then the 4th valuation was done due to this time delay. So I heard you guys discussing that there must be some expiry date for the valuation report. So there cannot be expiry on the liability of the valuer, but there must be expiry on the user of the valuation report. That this guy has signed the report, use it within 6 months, else it will expire. And SEBI guideline is saying this in case of valuation of real estate investment trust. That use the report within 6 months, otherwise it will expire. We need similar provision in Companies Act, in Income Tax Act, and in another act. Once the report is signed, user should use this report within this time frame. Otherwise, he is kind of similar to his not get done the valuation and he's just doing it simply. So what happened that the valuation was done by the valuer in CIRP case. Later, during this lockdown situation last year, due to rainfall, the stock was open to sky and the value deteriorated substantially. Now RP himself took a call that valuation report is no longer valid, and inventory was a substantial part of the whole value of the company. So he took the call and he get the valuation done again. In that case only, after several days, one of the debtor of the company which was under insolvency, and customer also filed for insolvency. So the second valuation, the first valuation report said that yeah, we will be able to recover money from this customer. But meanwhile, this development happened that this customer also went into CIRP, and now the prospects of recovering reduced. So committee of creditor called for one more valuation, and that valuation was also done. So the valuation, even after issuing valuation report, these things may happen. Another challenge is getting information from RP, because RP himself is facing a challenge of getting information from the management. That is the biggest challenge. Here we are talking about incorporating events which are happening after the valuation date, but in CIRP valuation, the ground reality is that getting the information up to the valuation date itself is a challenge. The correct nature of information. So in one case, what happened that the plant and machinery valuer was asking, I inspected the stock. Now I am going to prepare a report. Meanwhile, RP informed me that there was a fire in the godown, and he could not quantify that to what extent the damage actually happened. So that guy was asking me that what exactly to do in this case. So the ideal condition will be to go again, do the inspection once more, and then issue the valuation report. So these are the situations which a valuer faces practically.
It's very complex actually. Just one point before we come back to the topic with Anil's permission. In fact, today's program, I was a little skeptical on the number of participants, because at the institute we have a huge focus on MSME, and there are lots of events happening around that today. But happy to share, almost close to 4,000 are participating today. Just on the MSME day, for the benefit of all the members, I'd just like to highlight. One is from an accounting standards perspective. You are aware, for non-company entities, 31st of March, we have classified entities into 4 categories, which includes micro entities, and are given substantial relief. And for joint stock companies, 18th of June, MCA has, or rather 23rd of June, MCA has issued the Companies Accounting Standards Rules 2021, where the SMC definition has been changed to include companies right up to 250 crores. Music to Anil's ears. We have the audit standards. Globally, the audit standards are framed by International Audit Standards Board, Audit and Assurance Standards Board. Thanks to India's persistence since 2016, coincidentally the year when Anil and I joined the council, persistence since 2016, IAASB, with the support of other jurisdictions also, for our request, IAASB has taken up the project of having a separate set of standards for small and less complex entities. So the project was taken up last year. And for the small and less complex entities, generally equal to MSME, a fresh set of standards have been finalized. So it will be one single document with chapters inside, which is meant for the MSME. So today being World MSME Day, I thought I should share this, since this development has happened now. I'm not sure on valuation whether we can make that segregation of principles.
Would it not be fair to have a valuation day, World Valuation Day also?
Not a bad idea. not a bad idea. You can trigger that thought.
Yeah.
So,
Anyway, I think what you said was absolutely correct here, and I think long persistence has actually got us here.
I think
So,
credit to institute.
well, a lot of credit goes to you as well, MPB. So I think, and of course, a lot of your other colleagues who are part of your team there in the Central Council for the accounting science. So I think fantastic.
So just coming back, I just recollected it was the World MSME Day, and on audit standards, such a simple document, and it's exactly like the internal audit standards you are drafting.
Yeah.
They've brought it as one single standard with chapters inside that. Okay, so let me come back here.
So these standards actually are nothing but basics, and sometimes they are actually nothing but common sense, right?
Exactly.
And would love to see a date when there are no standards, MPB, and we'll put you out of job.
No, it's actually common sense codified is a standard. No, I'm very serious.
Yeah, I agree.
Common sense codified is a standard. So getting back here, Tarun.
Tarun, yeah, I've been very comfortable in all the other sessions. DCF valuation, income tax, Companies Act, do's and don'ts. But with all of your dates, written a comment that is valuation more important or valuation date more important. One of our viewers has put up a comment already. So anyway, back to you, MPV.
Yeah.
That was on the lighter side.
The dates are always complex. Can the date, so Tarun, getting back, can the date of valuation itself be a matter of dispute? And do we have instances where people have disputed on why this is the date and not some other date?
Fantastic.
Okay. So there are 2-3 such situations which may be there. Like one I was discussing as per the MCA circular itself, and as per the Ind AS 103 accounting for business combinations. So one such instance is this, where the date itself is to be decided. Like Ind AS 103 specifically says that you should do accounting on a date which is acquisition date. Now, what is acquisition date? They say is the date on which the control is actually transferred. Now, how do you decide that control is actually transferred on a particular date? So then they classify it into 2 parts. So one is where the court approval is required, like in case of merger, and the second is where the court approval is not required, say in the case of an acquisition, etc. So MCA circular has kind of helped all of us in this particular matter. MCA circular said that the merger date or the appointed date can either be an antedated date, that is before filing the scheme of merger with the NCLT, or it can be a forward date also. You can say that appointed date, today I am filing a scheme and I say that my appointed date is 31st of August 2021. Or it can be a date which is based on some trigger event also. Like when I get permission from Department of Telecommunication after getting NCLT approval, then I will assume that yes, this is the date when the merger will be effective. So Ministry of Company Affairs has allowed it through the circular. Those circulars are not binding in nature, but still that gives it a very good guidance. So as far as the court approval mergers are concerned, the date is now comparatively clear. But where the court approval is not required in those cases, then we need to check that what should be the exactly valuation date. One more such situation is there, though it's not an Indian situation. So one of the province in Canada named as Ontario, they have a provision that if a couple gets separated, then the property earned during the marriage period should be equalized. And for that purpose, a valuation is actually required. And the valuation should be on the date of separation. And date of separation means a separation without reasonable chance of resuming the cohabitation. So how do you decide that? So courts have given some guidelines on that whether the couple have started living separately even in the same house, or how do they socially represent themselves, or how do they file their income tax return. So not an Indian situation, But yes, this can be the situation where the date itself can be a dispute. And to the valuer, if the date is clear and if the client is giving some other date, definitely a valuer can educate the client about it.
So Tarun, say valuation, as most of us know, is a one-off arrangement. Of course, relationship and other assignments will come. But can we have a situation where the scope of work is such that the revision of report can be taken up in the light of new information as time progresses by? Can such a kind of an engagement be entered into?
Right. So again, I don't know why all examples are coming toward this side, because Ind AS 103 is again in business combination. It says that initially on the effective date of acquisition, you do the accounting and specify a measurement period concept. So suppose the effective date of acquisition in case of a merger or acquisition is suppose in November 2020. And now the December quarter is approaching. So they don't get a breathing space and they need to account for merger properly. And suppose they appoint a valuer, and even the acquiring company has not got a full feel of the target company, of the transferor company. So they acquired the best available information, they give it to the valuer and ask for evaluation. And this measurement period is up to 1 year. So if the merger effective date is November 2020, so up to November 2021, if any information arrives which gives further evidence about a condition that existed on the date of acquisition, then retrospectively that amalgamation accounting need to be changed. Now that's the duty of the management.
Okay. And coming to income tax, in fact, interesting session with Council Assembly Pramod Jainji 2 weeks back. With reference to income tax, can you give some input specific to valuation date? There are several provisions in the Income Tax Act which require valuation. So in each of those instances, what is the valuation date which is to be taken?
Right, sir. So now there are two things. Number one, when I'm doing valuation for the purpose of income tax, I'm doing a post-transaction valuation. Something has already happened, and maybe for the purpose of assessment or for the purpose of filing return, now I am making a valuation. So I will not make adjustment of events that occur after the valuation date. This is my professional judgment. So what should be the valuation date? Now here I don't have a discretion of valuation date. One of the most prominent section for valuation under Income Tax Act is section 56(2)(7)(b). So when a company is making allotment of its equity shares or preference shares at premium, in that case, if the issue price is more than the fair value, difference is taxable in the hands of the company. So that's why there is a need to calculate fair value. Now, there are three methods of calculating. There are three instances of calculating fair value. One is as per the book value method, that A minus L method. And the second one is the DCF method, which is done by merchant banker. And the third one is not given in the rule, but it is given in the section's explanation itself, that you can substantiate to the assessing officer that this is my value. So now there are three types of valuation under one single section. If I'm making valuation as per the book value method, Rule 11U specifically says that date of valuation is the date of receipt of consideration, not the date of it. Now this itself is a matter of dispute. So I received consideration in the month of March and I allotted share in the month of April, and suppose there is a taxability, there is some tax liability, should it be counted in this year or that year? That's a matter of dispute. Different authorities, different tribunals have given different decision. But there is no dispute as to the valuation date. valuation date should be the date of receipt of consideration. So, and interestingly, it says that you need to take audited balance sheet as on that date. So now today, if I am making preferential allotment of equity shares in an unlisted company, I'll have to get audited my balance sheet as on 27th of June 2021. Now, every time it's not feasible, so it gives me an option that, okay, whatever is the last available balance sheet, you take that. Now, the last available balance sheet is on 31st March 2020. So here itself, two dates are there. Either I can make valuation dated 27 June 2021, or I can make valuation dated 31st March 2020. Then coming on to the DCF valuation. In DCF valuation, the date is again simply the date of receipt of consideration. Then coming on to the case where I substantiate to the assessing officer that yes, this is my value, please don't tax it. So this is explanation A2, if I'm not wrong, of section 5627B. And here they specifically says that you substantiate the value as on the date of issue of share. So if I'm following rule 11 UA, that I am saying that, then I'm saying that date of receipt of consideration is the valuation date. And if I'm substantiating value to the assessing officer, then date of issue of share is the valuation date. Now, interestingly, there are some other valuation dates also. So if I talk about slump exchange, so the recent provision, in slump exchange, they have specifically mentioned the date of valuation will be the date of slump sale itself. So whatever is identified as the date of slump sale is your date of valuation. And the most complicated date of valuation I have found is under section 9 subsection 1 clause 1 911, that is indirect transfer. So there is an Indian company and a foreign company is holding, say, 60, 70, 50% shares in the Indian company. And the change in ownership of the foreign company happens, that Vodafone situation. So section 911 explanation 6D says that the date, they say that, okay, now here chartered accountants have opportunity to make valuation. It specifically says that if the Indian company is unlisted company, then you can take the certificate either from a chartered accountant or from a merchant banker. So they say valuation should be done on the specified date. What is specified date? So today, if the transfer is happening in the foreign company, shareholding in foreign company is changing. So you need to take the date of the date when the last accounting period ended, say 31st of March 2021. But interestingly, it says that if today the book value has gone up by 15% or more as compared to the last balance sheet value, then today's date should be taken as the specified date. So either if you want to take today's date as the specified date, then your book value must have gone up by at least 15%. Otherwise, the date on which the last accounting period ended should be the specified date. This is all just to identify a date, how to do the valuation that they have left to the chartered accountant or to the merchant banker.
Fantastic, yeah. I think MPV, I'm motivated to make a nice chart, colorful chart for dates, yeah. If, then, but, else. I think, Sarika, we should do something like this, yeah. And
I think you should
yeah.
tell participants about the 1st July publication on the question.
Yes.
Please go ahead. You should.
No, with Sarika would probably, towards the end announce that. So, yeah. But I think I'm pretty motivated. So let's see if we can put you, and of course, Tarun can help us to, see if we can put all the impacts of the date together in a nice kind of a calendar view for people to maybe, scroll through that. Very interesting. In fact, there's a very relevant question around slump sale board. So I don't know if MPV allows, I'll just quickly ask him, ask Tarun.
Please go ahead.
Suppose in case of slump sale, board approves acquisition in January 2021. NCLT approved merger in December 2021. With appointed date, 1st of April 2021. I'll repeat. Suppose in case of slump sale, board approves acquisition in January 2021. NCLT approved merger in December 2021 with appointed date of 01/04/2021, 1st April 2021. What would be the date for a fair value of consideration under section 50B of Income Tax Act?
So I believe board here means the board of directors, right?
Right.
And then NCLT approved it after. So I believe the appointed date which is passed by NCLT, which can be either antedated or it can be a prospective date, should be taken.
I think antedated, right? 1/4/2021 is what he's saying.
Okay.
Right.
So so I believe that should be taken, but it is as it is the area of the income tax. I'm not a tax expert. I'll kind of refrain from it, because under income tax they say, like, for immovable property there are different ways to measure when the ownership was transferred. For shares there are different ways to measure than when the ownership was transferred. So those guidance must be taken in mind rather than taking a clue from the Companies Act. We'll have to check the provisions of Income Tax Act, which can further, if some immovable properties are involved therein in the slump sale, and obviously there are most of the times. So from the Transfer of Properties Act, we'll have to take a clue that at what date the ownership was actually transferred. So that should be a better date for the purpose of tax law.
Fair enough. I think anyway we'll also try and get this kind of answered in the publication.
Maybe I'll attempt.
You have an idea, MPV? Maybe that
I have
could
an
help.
idea, but I would recommend checking with the tax expert. In a slump sale, in this example, it would be 1st April 21 would be the relevant date.
Right. Okay, please carry on. Yeah.
Tarun, so we have lots of questions from members. Maybe we'll try to have shorter answers so that we can cover as many questions as possible. A known subsequent event, should it be considered in the valuation, give the effect of that in the valuation, or to be only disclosed in the valuation report?
So as valuation standard says that it is your professional judgment, I will personally include it in the valuation itself.
Okay. And wherever you include in valuation, is it necessary to make a disclosure in the valuation report of the same?
100%, because valuation standard specifically says if you are using those events, you need to disclose it specifically.
Okay. Which valuation is binding on both parties pre-transaction, based on which an investor makes up his mind and does his calculation, or the one after the signing of documents, which may change, say, drastically?
So I'll quote here one example. Like the PE investor, what do? They enter into a non-binding agreement with the investor first, and then they do the due diligence, and then they arrive at, and specifically in the non-binding agreement it is written that after due diligence, if we find something, then we will revise the valuation. And once they are assured that yes, everything has been taken care properly, then they enter into a binding agreement. And once the binding agreement is entered into and thereafter anything changes, that's your luck. You'll have to bear with that.
Okay. As per section 247 of the Companies Act, it states that valuers should give declaration for 3 years prior and after the valuation date. Is this clause to be inserted in any agreement which is signed by the valuer?
I don't think so. The disclosure of this is required. Nowhere it is required that you need to disclose it. You just need to simply comply with it.
Okay. And how to treat the written down value of goodwill? Okay. This is a taxation related question, so let me keep that. We are planning one more session on taxation, so we'll consider it at that time. Valuation in case of an acquisition is done on a date as per agreement between acquirer and seller of shares will be acquired in a phased manner over an 18-month period. Whether value fixed will be appropriate at every phase of acquisition, and how the difference in value will be addressed?
So I believe the question is about accounting for acquisition under Ind AS 103. Phased acquisition, yeah, there are provisions under Ind AS 103 for phased acquisition. So again, the same test is there, the point of time where the control was actually transferred. Then that depends on a number of things that Ind AS 103 itself gives some of the example, like you may have agreed that 2 directors will be appointed on the board of directors from the side of the transferor company, and the date they are appointed, then we will treat that yes, this is the effective transfer of control. So that will be the first date, and the measurement period is open up to 1 year. And if any material changes occur between these dates, then a retrospective adjustment is needed. Even if the financial statements have been audited, submitted, then in the previous year's comparative figure, the retrospective adjustment will be.
And so there's see, the question, the way I have read it is following, Tarun. He talks about an agreement being signed for acquiring shares in stages. I'll acquire 10%, then another 10, another 20 over a period of 18 months. So if I do a valuation now, can I say that the same valuation will apply for shares acquired today 10%, 3 months later another 10, 6 months later another 20, or should we have separate valuation reports for each stage of acquisition?
So I believe that there should be separate valuation reports, because meanwhile, if the value increases, see, now this is something that if 2 parties are agreeing together that yes, we are ready for this, because as I said, under the Companies Act, there is no specific expiry date for using of the valuation report of the valuer. But I personally feel if I am the valuer in this situation, I'll say at least take a new valuation report every 3 months.
Okay.
That's what I will practice.
Okay. There is one question with an example which a member has asked. Date of signing share purchase agreement for round 1. 1st June 2021 is 50 shares. Date of valuation for second round for issuing 100 shares is 2nd June. Date of receipt of money from the first round is on 5th June. Date of signing valuation report for second round is 27th June. So the question is, should we consider the 50 shares of first round for valuation of the second round, despite the fact that the first round money is coming after the valuation of the second round?
Yes, I'll say, because receipt of money is not important. What is important is the signing of the agreement and with whom you have signed the agreement. Suppose you have signed an agreement with a very good strategic partner. So as soon as he comes in, the value will suddenly shoot up. And even if it is 2nd June, I believe the advantage which was received with the first June agreement should be taken into consideration.
Okay. So just coming back a little to valuations which are done for financial reporting purposes. Based on whatever we have discussed so far, there may be 3 different treatments for same set of post-valuation dates for income tax purpose, Companies Act purpose, and Ind AS. Can you illustrate that with an example?
Okay, sure. So now, interestingly, we can distinguish between the valuation standard and the accounting standards also. So allow me to create one example. Say it is 31st of March 2021, and on 31st of March 20, we are talking about an unlisted company, let's say. And suppose Ind AS is applicable to that unlisted company because the net worth is about 250 crore, or maybe it is an associate of listed company. So it is 31st of March 2021. A court case is pending against the company because the MP government has asked for payment of 200 crore rupees as the water tax. And there is 50% probability that company will win this case. This was as on 31st of March, balance sheet date. In the month of April, actually the final hearing was there and company lost the case. And now there are less chances or least chances of winning in an appeal. So kind of we can say now it is 100% sure that 200 crore liability is there. So this is one thing which happened after the balance sheet date in the month of April. Also, this company has made investment into some listed company for the purpose of its cash management maybe. And that's a substantial investment. And in the month of April, due to some government policy change, value of that company decreases substantially, or due to discovery of a fraud, the value of the company reduces substantially and it is not expected to be recovered now. So two things happened. One related to company, it's lost a court case in the month of April, and number two, it made investment in another company and a fraud is discovered in that company. So its value also decreased. Now suppose I am making valuation under the Income Tax Act, say maybe 1 year later or 2 years later, or whatever purpose I am making valuation under Income Tax Act, and my valuation date specified under Income Tax Act is 31st March 2021, and I am using DCF technique. So there may be question, chartered accountants can use it. Yeah, in some cases chartered accountants can use even the DCF valuation. I will ignore both events. See, I have taken two events, one which existed at the balance sheet date and for which we got further information thereafter, and second, an event which occurred after the balance sheet date. While making valuation under the Income Tax Act, I will ignore both of these events because I am doing a post-transaction valuation and I cannot use the benefit of hindsight. I'll have to stick to the value which was available as on 31st of March. Then if I am making valuation, say for the purpose of Ind AS, and again the valuation date is 31st March 2021. So going by the provisions of Ind AS 10, I will consider first event which says that the condition existed and then I got the information later. But I will ignore the second event where the event occurred after the balance sheet date. So one considered, one ignored. Under income tax, both ignored. Under Ind AS, first one considered, second one ignored. Okay. Now, interestingly, say under the Companies Act, company decides to make preferential allotment of its equity shares. On 1st April itself, the board meeting happens and they appoint me as the registered valuer. And on 30th April, that is after happening of both events, I am signing the valuation report. Here the valuation is for the purpose of allotment of share, which has not yet happened, which will happen later. So I'm doing a pre-transaction valuation. And now my professional judgment says that I need to consider both events. So under income tax, for the same date, I ignored both. For Ind AS, I considered one adjusting event and ignored the non-adjusting event. And for the Companies Act, the pre-transaction valuation I am doing, I have considered both. 3 different treatment for one single situation.
That's helpful. In fact, there are many members who have observed that the subsequent events are very, very important in a valuation exercise, which is echoing what you have said. There's one question here which is there. Sometimes valuation is required for recording assets as a balance sheet date. The member is said 31st March. Do we consider post-valuation date events in such cases as well?
So probably in the last example it is answered. So in days 10 we will go by. So the event which gives a proof about something which existed at the balance sheet date, but the information is arrived later. Those events should be adjusted because I'm doing valuation for the purpose of accounting. An event that occurred after the balance sheet date, as Ind AS 10 says that you need to make a disclosure of it. So similarly, taking a clue from over there, I will definitely like to make a disclosure so that company can use that disclosure for the purpose of their own disclosures in financial statement.
Okay. So Tarun, there's a question from member. In case of a capital reduction scheme by MNC for forced exit of minority shareholders. So the NCLT took about 3 to 4 years, and in between the company's performance has improved dramatically. So can shareholders insist on a separate valuation to be done now?
Yeah, actually they can if there is any judicial authority. So definitely shareholders can. So if I put it differently, can shareholder take an objection to the valuation done? Like in the current PNB housing scenario, we are seeing that somebody has taken an objection. So can shareholders take an objection on the valuation which was done? Definitely, if they feel that meanwhile the value has changed, they can submit it to the relevant judicial authority, and then it is up to the judicial authority to order one more valuation. Like in CIRP, RP takes a call or COC takes a call and they get the valuation done again. So similarly, in this case, you can definitely at least make your point to the authority. Now it's up to them whether they consider it or not consider it.
Okay. So there are few banks who have a requirement of valuation date not being later than 3 months for FEMA purposes. Is this the time period specified under law?
No, I don't think so that any time is specified under FEMA, but this has become a practice that for RBI valuations they usually discourage something which is older than 3 months. So this has become a practice rather than a provision.
Okay. Now, this is a question not really relating to valuation date, but nevertheless, from your experience of handling valuations, what is the way out if there are wide variations between reports of two valuers who are doing valuation for the same valuation date?
So, if we are talking about the valuation under IBC, because there they appoint two valuers, two for SFA, two for land and building, two for plant and machinery. Insolvency and bankruptcy code and the regulations thereunder specifically says that if the two valuers have given the valuation and the valuations are far away, then the resolution professional will actually appoint a third valuer, and whatever two valuations are close together, he can take an average of that. So third valuer will be appointed in that case.
Okay. And so we have been talking about adjustments for the period between valuation date and the valuation report date. Now, if a management refuses to consider adjustments to be done in the financial projections or other ways, what would be the responsibilities of the valuer? How should the valuer respond to such situation?
Now that's the actual practical situation, because many times the management may not cooperate. So now let's divide it into two parts. Number one, without the intervention of the management, I myself can procure the information, because that's not about the company, that's about the parameters I'm using or comparable I'm using. So I will give them, first of all, I'll definitely try to educate them. Otherwise, I can give a valuation date valuation, and then I can make a disclosure that the value on this particular date was this. Thereafter, these events happened. And if you want to see a true value on the report date, then the value will be this. The disclosure can be made so that at least the valuer has done his job properly and he will not be questioned. But if the information is to be obtained from the management about the events which happened between these 2 dates, then I'll say you should refrain from doing such a valuation.
Okay. This is a very interesting question. In fact, just for the benefit of members, We will plan a separate Sunday on valuation of stock options, particularly the modeling aspects, because I know there are many young members who are taking up such valuation exercises. So the query is valuation for purpose of getting fair market value in an ESOP situation for an unlisted company. Who can do the valuation? Merchant banker or a CA firm?
So there are two valuations which are required. Under the Companies Act, the valuation must be done by the registered valuer for ESOP. But under income tax, the valuation must be done by the merchant banker. That valuation is required at the time when employee exercises his ESOP and not on the date of issue of ESOP.
So there's a follow-on question from the same participant. Whoever does the valuation, whether the RVO rules apply on merchant banker or a CA firm as well, and the valuation date, assumptions surrounding excise date of options, and data valuation report. How can all of them be aligned?
So there are two questions, I think. One is, if I am a chartered accountant and not a registered valuer, am I bound by the rules which are there of ICAI RVO? And the answer is obviously no, because I am not a member of ICAI RVO. You need to take a separate membership of ICAI RVO besides ICAI. So if I'm just a chartered accountant in practice and not a registered valuer, I'm not bound by the rules of RVO, number one. Merchant bankers are obviously not bound by either the ICAI rules or ICAI RVO rules. And number two, how to align these dates. So, see, I would say in that case that aligning the date is not a problem. The problem is of making efforts. So it's like I'm talking about small ticket valuations also, because what happens that management, they first of all, they don't want to get done the valuation. First thing, why do we need it? And thereafter, when they come to know, no, the valuation is actually required, they will insist, okay, this is our balance sheet, you take the book value, certify the net worth. Then I educate them, see, I can't do it, I will have to do it with DCA for comparable company. Oh, a lot of work is to be done. So you can align everything, all the dates can be aligned. The only thing is the effort involved. Now, whether your remuneration is commensurate with the effort involved, then you take a call, you want to do that job or not.
Okay. So just one more.
I like the last line.
Go ahead, Anil. Go ahead, please.
No, I said I like the last line. Yeah. Go ahead.
Okay. So Tarun, here is a practical case of one of the participants. This is transfer of shares of an unlisted private limited company, unlisted and private limited company, which is an NBFC and has only investment in Indian listed companies. The valuation is done by the company itself based on formula given in section 50C on 1st April 2020 based on the closing market rates of 31st March. And no valuation report has been obtained from registered valuer or merchant banker. The shares were transferred subsequently by the board in the first week of April, and partial payments also were affected. Can Income Tax Department ask for valuation report, keeping in mind that the prices have gone up substantially post transfer of? So
yeah, number one, this is the for transfer of share, you never need a valuation under the Companies Act, so no role of the registered valuer. This will call for evaluation only under the Income Tax Act, that too section 50CA. And 50CA refers to rule number 11 UA sub rule 1 and then C and then B. 1CB, yeah, it's there. So the 1CB is A plus B plus C plus D minus L. And that A, B, C, D, L, what they are saying that management took, management cannot take the market value. If the accounting itself is done with the market value, then only, because A, B, C, D, L rule says that you need to take the balance sheet figures. You need to take balance sheet figures. And if in the audited balance sheet, value of investment has been considered at the market value, then for the purpose of income tax also you can use that. But I'm not aware that how do NBFC, is it compulsory for them to account for it at the market value or what? If they are doing the if they are making balance sheet based on the cost basis, then for the purpose of income tax also they'll have to take it, because they are following the audited balance sheet, full stop. No valuation report is required in this case. We'll have to follow whatever is written in the audited balance sheet. Now comes the point later, if the value increases substantially. So I said here the date of valuation must be date of receipt of consideration.
Okay. Tarun, will try to keep the answers little faster now. We're coming to the last leg. So what will be the position in the case of convertible shares or debentures? Which valuation date will be applicable? The date of agreement or the date when actual conversion takes place?
Now, this is a very important and interesting question. Many people commit a mistake over here. Even in case of big companies, I have seen that they have done the mistake. So rule number 13 of share capital and debenture rule specifically says that you have choice in case of convertible securities either at the time of issue or at the time of conversion. It simply says that. But I strongly believe that if the conversion ratio is decided in advance, that one debenture will be converted into 2 shares, then the valuation must be done now at the time of issue. But if the conversion ratio is not decided and you say I'll convert these debenture at whatever fair value exists on the date of conversion, then valuation, there is no point in making valuation today, then the valuation must be done in that day.
Okay. So you're almost coming to the concept of fix it for fixed and the other situation. Okay, fine. There's a similar question which is also interesting. If warrants are issued with an exercise date of 2025, exercise price being 25% discount to 2025, there is need for valuation report now as per Companies Act. How will this valuation report capture the value on the current date of issue of warrants?
So I believe what the question is that the exercise price itself is variable. So if that day the share becomes 100 rupees, then we will issue it at 75 rupees. Definitely, where there are valuation models, that valuation can be done. And this is kind of, you are making a forward valuation or a projected valuation. Usually we don't certify projected valuation, but even if I am calculating value as of today, the projected value itself is a part of it. I'm saying today value is 100 because first I calculated that after 5-year terminal value will be 200. So it means that I am somewhere calculating projected value, and that can be used for the purpose of valuation of this option. Just in a routine course, no special effort will be required.
Okay. Just a couple of questions, not really related to date, but it'll be nice to educate the members. Is report from registered valuer compulsory in case of buyback of shares?
Now, difference of opinions are there. Section 68 does not demand any report for this, but if it is under section 66, then a report will be required. 68 buyback doesn't require, but for corporate governance, many people take it nowadays.
Okay. The other question which is there is, if I have to value an asset as at 1st April 2019 for the first time Ind AS adoption with valuation date of 27 June 2021, should I make adjustments for COVID?
Now this is very interesting.
Report date of 27 June.
I have personally done this thing, and this is very interesting. So a company became I'll be quick. A company became associate company of a listed company, and they asked me to do 3 valuation: 1st April 2018, and then 31st March 2019, and then 31st March 2020 for Ind AS 101 first time adoption. Now at this point of time, it's very difficult to control yourself from using the hindsight, because you know what has already happened with the company, and you are making valuation of on a date which is 2 years or 2.5 years or 3 years behind. So definitely one should not use information. This is a post-transaction valuation, and therefore anything which happened between 2018-19 and this date, COVID effect should not be considered. That will be hindsight if you consider it.
Okay. Again, a similar question, because many people have asked, maybe I'm repeating a question which is close to this. A company has entered into a non-binding agreement with a strategic investor in May 2020. Agreement was for transfer of business at a valuation of $100 billion. And the modalities would take about 2 years to complete the transfer. After 2 years, both parties are in agreement to transfer the assets at $100 billion. So consideration is 100. However, if we do a valuation as at a recent date, it will only be $80 billion. How will accounting take place in the books of the seller and buyer?
Transfer of business, so we'll have to take guidance from Ind AS. And I am not sure, sir. Here you will have to help me out for date at least.
Okay. As far as the accounting is concerned, it's only 100 billion. And in purchaser's book, you'll have to test for impairment and recognize the same. So let me come to the last question, Tarun. I have heard you in a different platform speak on the PNB aspect. I know it's sub judice, but I just want to conclude on this. Imagining a few situations are likely to happen. If, let's say, they were to take a fresh valuation report, would you consider these developments which have taken place and the fact that Carlyle has participated? So what are those potential situations and how would you respond to that? So that's the last question, and thereafter back to Anil. Over to you, Tarun.
Yeah, so I will call it that now we are going to tell a fictional story. It has nothing to do with what is actually happening. We'll take some real facts and then some add hypothetical facts over here. So what happened that PNB Housing Finance decided, when their market capitalization was 6,400 crore rupees, they decided they want to make preferential allotment of equity share, procuring 4,000 crore rupees from Carlyle Group mostly. And they followed the SEBI guidelines also. And the SEBI guidelines were saying that, okay, 26 weeks average and 2 weeks average, whichever is higher. And accordingly, the price was 390 rupees. Now, thereafter, one proxy advisory firm took an objection that this is the floor price. This is not the valuation. Your own article of association is saying that you will issue share only after taking report from registered valuer, number one. And number two, this new investor will be in a controlling position. They will be having around 40% shareholding in the company. So you need to add a control premium to that. And they went to the SEBI. SEBI tried to stop it. Company went to the Securities and Appellate Tribunal. Now, Securities and Appellate Tribunal said, okay, let the EGM happen, let the voting happen, but we will give our decision on 5th of July, which is coming. Now, let's take a hypothetical situation that on 5th of July, Securities and Appellate Tribunal says that, okay, let's get done the valuation so that nobody raises a finger thereafter. And they appoint a registered valuer. 5th of July, they appoint a registered valuer to make a valuation as on 31st of May 2021. Why as on 31st of May 2021? Because that was the date of board meeting of PNB Housing Finance Limited, where they passed the resolution that yes, this is the price at which we want to proceed. So now on 5th July, SET appoints you as a registered valuer to do valuation as at 31st May 2021. That the price discovered by them on that date, was that a correct price? So I believe in this case, this will be a post-transaction valuation kind of situation, because they are not asking you what is the fair value today. They are asking you, was that a correct value? The question may be, should valuer consider the event which happened between 31st May and 5th July? And between 5th July and the date when he will sign the report, say 20th July. So I'll say definitely he should not consider those subsequent events. Number one, that's my opinion. And one more interesting thing I would like to add, where our valuation standards give a very good specific guidance. 102 basis of valuation. They say fair value is something which consider all the circumstances which are available to market participants in general, but it does not include the advantage which is available to a specific participant. Now, what is happening? The question is, while I am making valuation, that should they have allotted the share to the Carlyle Group, I'll say they should consider control premium, which they should consider all the advantages which would be available to any private sector player in this situation. But if there is any strategic advantage which is available to the Carlyle Group only, that should not be considered in the valuation. So that is what I think.
I think for your age, you have answered it extremely well, Tarun. I think the choice of words and the way you put it. Thank you for that.
Absolutely.
Yeah. Over to you, Anil.
No, absolutely. I think this has been one of the most articulate sessions that we would have done so far, and has been amazing amount of clarity in terms of what Tarun has spoken. So thank you so much. I think this has been a fantastic session, and personally, I had no idea dates were so complicated. I thought dates were dates. So that's a great learning experience. I've been quietly listening to both of you gentlemen today. I think, and I must say that we would probably have to redo this another time. But as usual, I think Sarika would want to trouble you, Tarun, to maybe, because we've got a lot of questions, and we're coming out with some publications which I think Sarika will talk about, but we would trouble you and try and see if we can, get answers to these questions. Besides a calendar of dates, if we could, and dates and events and, post and pre and all of that we could, kind of summarize somewhere. So thank you to you, Sarika.
Yes, sir. Thank you, sir. Thank you, Mr. Tarun Mahajan. Just one thing to add after Anil sir has already briefed everything and talked about everything, but MTV sir has articulated the questions the way he asked the questions. But when we decided this topic, we were not very sure that this will be so complex. We thought
I didn't know it would last for. I didn't know it would last for 1.5 hours. Yeah, fair, honestly.
Yeah. It is actually creating confusions in the minds of registered valuers or valuers that actually the calendar of dates, which Anil Bhandari sir has already spoken. Tarun sir, we will take your help to finalize this. We are going to release it on 1st July. So you have only 2-3 days to prepare this calendar. Okay. And already we have been telling that we will be releasing answer to the questions of all the 6 VCMs, including today's VCM, on 1st July. Thank you all the participants for participating with such an enthusiasm on a Sunday morning. And today again we have 4,000 people. We didn't expect that 6th Sunday in a series we'll be having such a good participation. Thank you MPV sir, thank you Bhandari sir, thank you Segal sir, and thank you Mr. Tarun Mahajan for being so interactive and taking all the questions forward. Thank you all.
Thank you. Thank you, Sarika. Thank you. Bye, everybody.